The reason you're not profitable isn't because the market is against you. It's because you don't know how to properly read market structure and order blocks. Right now, you're entering trades without understanding where price has been, where it's currently reacting, and where it's most likely to go next. You're buying just because price looks cheap. You're selling just because price looks high. But the market doesn't move based on how you feel, it moves based on structure and liquidity. When you don't understand market structure, you don't know the trend. You don't know if the market is making higher highs or lower lows. You don't know whether you're trading with momentum or fighting against it. And when you don't understand order blocks, you don't know where smart money actually enters the market. You don't know where institutions are buying, where they're selling, or where price is most likely to react. So instead of waiting for price to come to a high probability zone, you chase candles, you enter late, you move your stop loss, you hope the market will save you. That's not trading, that's gambling. In this video, I'll show you how to properly read market structure and accurately spot order blocks so you can stop guessing and start trading with clarity. You'll learn how to identify the true trend, understand where price is being respected, and recognize the key levels where institutions step into the market. I'll break it down step by step using real chart examples, so even if you're a beginner, you can follow along without confusion. First thing first, we have to identify the trend, whether the market is bullish or bearish. In this case, it's very clear that price is bullish, with higher highs and higher lows showing strong buying pressure and control. The market has just shown a structure break, with the price closing beyond the previous swing level, confirming that the old support or resistance no longer holds and suggesting a possible shift in market direction. Price did not actually break market structure here. What we're seeing is not a real breakdown, but a liquidity grab below the previous swing low. Smart money pushed price below the swing to trigger stop losses from early buyers and trap breakout sellers. Notice how the candle quickly gets rejected and fails to continue lower. This tells us there's no strong selling pressure. Instead of continuation, price is simply collecting liquidity below the lows, which is a classic manipulation move. After the liquidity grab, price creates a clear change of character. This tells us momentum has shifted from sellers to buyers. Instead of making lower lows, price now starts respecting higher structure, confirming bullish intent. From this move, a fresh demand zone is established. This is where smart money stepped in and defended price. Now, instead of chasing price, we wait patiently for price to retrace back into this demand zone. This area becomes our high probability buy zone, because it's aligned with structure, momentum, and liquidity. For targets, we always think in terms of risk to reward. You can safely set target 1 at a 1 to 2 risk to reward, locking in partial profits and reducing risk. If momentum remains strong and structure continues to hold, target 2 can be extended to 1 to 3 or even higher, aiming for the next liquidity or previous high. This way, even if not every trade wins, the winners always outweigh the losses. That's how consistency is built. Let me show another example.
This is not a break of structure, it's just a liquidity sweep. Price did not actually break market structure here. It simply swept liquidity below the previous swing, triggering stop losses and trapping early sellers. To confirm a real break of structure, we need a strong candle body close above the previous swing high, not just a wick. Wicks only show rejection or stop hunts. They do not confirm control.
Just waiting price to mitigate the demand zone. This mitigation is important because it confirms that the zone is still valid. When price taps back into demand and shows a clear reaction, such as strong rejection, displacement, or bullish candle structure, that's where we look for buy opportunities. Buying from the demand zone allows us to enter with low risk and high reward, because our invalidation is clearly defined below the zone. From here, we can target the next liquidity pool or previous highs, easily setting a 1 to 2 or 1 to 3 risk to reward trade. Right now, we simply wait for price to come back and mitigate the demand zone again before looking for buys. There is no rush to enter the market. After the initial move, price often retraces to rebalance inefficiencies and fill institutional orders left behind in the demand zone. Price has now mitigated the demand zone, but in this case, the demand zone failed to hold and price swept the previous swing low. At first glance, many traders would see this as a reason to panic or flip bearish. However, in smart money concepts, this can actually be a bullish sign. When price sweeps the swing low, it clears out sell-side liquidity and stop-loss orders sitting below that low. This move is often engineered to trap late sellers and remove weak hands from the market before the real move begins. The key point is that liquidity has now been taken. Once stops are cleared and price starts to show strong reaction or displacement back above the zone, it suggests that smart money is absorbing sell pressure and preparing for a move higher. This is why we don't sell after a simple low sweep. Instead, we wait for confirmation such as a change of character or strong bullish candle close before looking for long opportunities. Here is my last example. I will show you guys. First things first, we have to identify the overall market trend. Before marking zones, looking for entries, or talking about liquidity, we need to ask one simple question. Is the market bullish or bearish? Once the overall trend is clear, everything else becomes easier. Liquidity sweeps, demand and supply zones, and entries all make sense only when they align with the higher timeframe trend. Here we can see that the bullish swing has turned into a bearish swing. This tells us that price has shifted momentum to the downside. If you still want to look for long opportunities, the key is patience and confirmation. We don't buy while price is bearish. Instead, we wait for price to show bullish intent again. One of the strongest confirmations is a change of character. Once a valid chock is formed, we can then start marking new demand zones and wait for price to retrace into those areas for a higher probability long entry. Now we wait for price to mitigate the demand zone first. There's no rush to enter the trade. After structure shifts and bullish intent is shown, the next step is patience, letting price retrace back into the demand zone where institutional orders are likely sitting. Once price taps into the demand zone, we drop down to a lower time frame to look for confirmation. This is where we want to see clear bullish signals, such as an order flow shift or a clean break and body close above a minor high. Lower time frame confirmation helps us avoid false entries and improves timing. Instead of guessing, we let price prove that buyers are in control before executing the buy. With confirmation in place, our risk is clearly defined below the demand zone, while our targets remain at previous highs or liquidity levels, allowing us to aim for 1 to 2 or 1 to 3 risk to reward setups. Higher time frame gives direction, lower time frame gives precision. This is how patient traders execute high probability longs, while most traders chase moves too early. If this helped you understand the market even a little bit, don't waste that edge. Most traders lose because they never learn how price actually moves. Subscribe to this channel. I break down market structure, liquidity, and real trade logic step by step, so you stop guessing and start trading with confidence. Stop gambling, start trading smart. See you in the next video.